Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. I have 26 companies in this portfolio, 25 and then an ETF. Now it's very difficult to kind of go through every single one of these companies individually, and this is why honestly, if you are a starter and you are starting your journeys, you're better off looking at ETFs instead of having 25 to 30 different companies, because it is difficult to maintain them. What I mean by that is every time they report their earnings, you need to look at their earnings report and see how the company has performed. Okay, maybe quarterly doesn't make actually a huge difference, but yearly, at least every single year, you should be looking at the 10K and see where the company is heading. Quarterly, just keep an eye on it, but don't make any decisions based on that quarterly, because one quarter could be down, the other one could be up. What matters is where is the company at the end of the year. Now, like I said, the 25 companies I have in my portfolio, I normally look at them when they report their earnings, but there's some companies in this portfolio that I haven't spoken about in ages. So I haven't done any full analysis. I haven't looked at it. And I do that for myself a lot. So I always like to make sure that after each earnings report, I look at the company and say, okay, is everything still okay? Is the company heading in the right direction and so on? So it takes a lot of time. So what I want to do today is I want to look at one of the companies that I haven't looked at in ages with you guys. Normally I do this for myself. I just do quick basically analysis on the latest report as well as where the company is and where it's heading and so on, based on the analyst out there, based on the information that's available to me. So what I'm going to do today is look at a company called Medtronic. Medtronic is one of the companies that I've had in my portfolio for a long time. It's down quite a bit. I'll share all that information with you guys in a second. But before we do that, before we jump into the actual video, I would really appreciate if you can help me here, because it takes a lot of time to put these videos together. And the reason I'm doing it, honestly, is just to kind of give you information out there. Some of the analysis I do is actually, I'm not digging deeper into these companies, because I don't want to make the videos long, as well as obviously I want to give you the overview, and then you can go away and do your own research and find out a bit more information. Take your time. It's not one day thing. Sometimes it takes me 3-4 days to actually look at the company fully. Okay, so have a look at basically the videos that I provide, but always make sure you actually do your own research. And doing that research, finding out this information, takes a lot of time. So I would really appreciate if you can just like the video, subscribe to the channel, because that's all I ask. Okay, and obviously if you're interested and want to join us, okay, then you can join us and support the channel. Okay, you can just for £2 you can get all of this. For £4.50, whatever it is, you can actually get access to all of this, including the Sharia compliant and basically invest in ebook. So there's a lot of little things that you could do to help me, obviously. So please do if you can. Right, Medtronic is the largest manufacturer of biomedical devices they have basically in the world. It basically serves physicians, hospitals and patients in more than 150 countries and has over 90,000 employees. It has 4 operating segments. So they have cardiovascular, medical surgical, neuroscience and diabetes. The company has generated closer to about 31 billion in revenue in basically last year, and they have reported recently their earnings. So looking at the earnings that they reported recently, you can see each section and how much they have made. And diabetes was actually the lowest. Okay, so 578 million, and cardiovascular was about 2.8 billion. Then you've got medical surgical, which was about 2 billion, and another 2.2 billion of neurosciences. So you can see their products is very much diversified, but majority of that comes from these 3 sections. Okay, the diabetes section is actually quite small. In terms of basically globally, you can see in the US, okay, in the United States is actually the biggest. So it's about $4 billion came from the US last quarter. And then you can see also the non-US developed, okay, is about $2.4 billion, and then emerging market is about $1.3 billion. So I like the fact that it's diversified. It's not just focusing on the US and so on, and their products are everywhere. No matter where you go, if you ever go to hospital, God forbid, for any checkup or whatever it is, you will see some of their products actually used. Okay, now a couple of more things that I want to show you. They have last 12 months they have 125 product approvals in key geographies. Okay, and they are here. I don't know some of these things, so if you're interested, you just have a look at that. But yeah, so you can see they have a wide range of products that have been approved in the last year. Then when you look at each section, so cardiovascular was up about 6%. Okay, last the report that they just reported. If you look at neuroscience, for example, was also up another 6%. 6% for medical surgical. However, the diabetes was actually not up by much. I think it was down a little bit. So let me see. No, it was actually up as well. Okay, it was up, but obviously it is a small section of their revenue. So that's the 4 sections the company reports. So what I would do if you were really interested in this, and you obviously have a background maybe in working in a hospital and so on, you can look into these devices and basically where are they used and who uses them, and different companies, hospitals, are they in the UK? Obviously they are in the UK because by the way, this company is registered in Ireland. It's not even registered in the US. But yeah, you can have a look at their products and see what is on the pipeline, what's coming up, and find out the technologies and where they use a little bit more information. The other thing I love to do is I love to go on YouTube and actually look at the employees, what they say about the company, any videos that basically talk about the company it doesn't matter, go to the company website, look at the type of product, how much they sell it for, and then you can look at the financial, look at the 10Ks, look at who's running the business. Okay, are these people actually competent enough? Have they been around the company for a long time? Do they actually own stocks? Okay, it's very important to check basically insider ownership, because if the company has insiders basically owning the company and buying when the stock is down, that means basically they value the company higher than where it is, or where basically Wall Street thinks it should be. And now we're going to look at the financial side of things. Okay, this company, like I said already, is in the healthcare sector. Right now it's trading about basically $80 per share, and it has an EPS of $2.72. The market cap is $106 billion, and it has a wide economic moat, and beta is quite low, which is really nice. Now in terms of PE, it seems quite high right now, about 29, but when you look at the sector, it's about in line with the sector, and the S&P 500 is actually about 23 right now. The forward PE though means basically it's actually cheaper. Okay, 15 PE right now, and the 5-year average is about 21, so it's more expensive than the 5-year average, but looking forward it seems it's slightly cheaper. Price to free cash flow of about 23 as well. Now in terms of dividend, this is where the company shines. This company is what's called a dividend aristocrat, because they have increased their dividend over 25 years, closer to 50 now. Another 5 years this company will become a dividend king. So the annual dividend yield is about 3.45% right now, which is higher than I have seen for this company for a long time. The payout ratio is just 51%, but the latest increase was basically 1.5, which is kind of pathetic, but I think based on what the company was trying to do, I understand. But the 5-year growth rate is what matters really. That's about 8%, which is quite nice. I hope in the next 5 years or so, they can, once basically the company starts making more revenue and so on, hopefully this can increase into at least the double digits. The dividend growth streaks 45 years, I've already said. An annual payout, we're looking about $2.76. The dividend safety is 99%. Free cash flow right now is $4.44 billion, which is healthy, and free cash flow yield of 4.2%, which is quite higher than the 3% we require, and free cash flow margin of 14%, which is also very, very good. Profit margin, we're looking about 11%, 12%, and operating margins about 18%, return on equity about 7%, and total return in the last 10 years, we're looking about 6%, which is not huge if you think about it, but hopefully going forward. Remember, this does not tell us everything. It tells us what's happened in the past. So what we betting on is basically the future of the business. And I'm hoping that basically will do better than this, because 6.4% doesn't actually beat the market. The return on invested capital is about 5%, and revenue in the basically last 5 years, the growth side of it is 0.8, so it's flat in the last 5 years. So this is why I'm hoping the company to do something, okay, whether they have and I'll show you in basically what the analysts expecting of this company in their list next 5 years, but this is basically what they've done the last 5 years. So let's see what happens in the next 5 years. In terms of current ratio, is actually fine. We're normally looking for anything above 1. And growth estimate for next year is about 7%, and the growth estimate next 5 years is about 3%. Now let me quickly show you now. If we go to earnings in Seeking Alpha estimates, okay, what you'll notice about 7%, 8%, 8%. So it's actually helped better looking at basically moving forward than actually where it is right now. So it will recover. But there's one person who is expecting about 15% in 2029. But 6%, 8%, this is the... Normally when I invest in this kind of business, I'm expecting at least 5 to 10% in between. Okay, there are some companies I expect obviously double digits, like 20%, 13, 14%, all the way to 25%, 30%. But this is not one of those companies. Okay, and revenue from $32 billion to, let's say, in the next 4 years to $36 billion. Okay, that's 4%, another 4%. So let's call it about 5% growth. So this is, I know this, and I'm investing in this business knowing that I will get between 5 to 10%. Okay, that I made up. I know that for my portfolio, I expected that. Okay, but some of you might be sitting there thinking that's very low. Of course it is low, but for a balanced portfolio, you're not going to have high flyers. The fact that this company has a lower beta, has an excellent dividend, has been paying it for a long time, that solid, predictable kind of business, sometimes I need that. I need some of those stocks in my portfolio. And that's why it has basically a position in my portfolio because of the things that I've just said. Now, in terms of moving forward, basically in terms of valuation, Morningstar is saying it's basically 29% right now discounted. So they think the price should be $112. Simply Wall Street is saying about 7%, £85, dollars or whatever it is, and is what they expected. And then when it comes to tip rank, it's about 94, so it's about 18%. It's a moderate buy according to them. And then Seeking Alpha, $95, 18%, and is a buy from them. So it is discounted, and I'm happy to accumulate more of this company as we go along, inshallah. Now, in terms of business side of it, it's 100% is fine. Interest-bearing debt is about 21%, and then interest-bearing securities is about 6-7%. And as you can see here, they actually, I think they were acquiring another business when they actually diluted the shares, but since then they've been buying back their own shares. So they're buying back their own shares. They have a solid dividends. They're growing 5 to 7%. The beta is very, very low, and for that reason, that's why I have this company in my portfolio. It basically has a predictable business that is needed across the world, and for that reason I'm gonna keep it. I'm gonna add to it whenever I get the chance. Just to be transparent, to show you, I have 45 shares of this company, about £3,000. I'm down about 13% right now. So in the next few months you will see me adding a bit more of this company to my portfolio. I think I was buying when it was actually $92 per share. Not bad. Okay, $92 per share. So right now we're looking at about 80, so it's fine. I'm gonna keep it. I'm gonna add to it, inshallah, going forward. And like I said, again, it's one of those companies, like, it's basically slow growers, but obviously has a position in my portfolio. Absolutely, you can't always have high flyers. That is the company I wanted to talk about today. There are a few other companies I haven't spoken about for a while, so keep up, look out for these companies. Inshallah, I will be doing similar sort of a thing, inshallah, moving forward. If you haven't actually joined us on the Discord and the Patreon account, please do so. That really helps the channel. Like the video, subscribe. There's more videos coming up, inshallah, in the next couple of days. So subscribe, and so you don't miss anything, inshallah. Have a wonderful day. Assalamu Alaikum.